I wanna rock. How you guys doing? Welcome back. I thought I'd do the show from this angle today because some of you guys can't see enough of me. How's it going? Welcome back. I don't know if you can hear this background noise or not, or you can just hear my voice. But I gotta tell you, there's a hole being dug outside, and it is now being pumped with some kind of a pumper unit. There's a city cruiser out there. I don't know. Whatever it is, it is. So I hope it's not too uncomfortable for you out there listening to me live on the show. Hope it's all right. It's the final countdown. That's right. We're into the last hour. Welcome to Stock Markets with Bruce. I'm Uncle Bruce, and it's the last hour of the trading day today. Hasn't been a lot to talk about here. It hasn't been full of incredible excitement and breaking developments. The Dow is down 66 points. So that's the low point of the day, kind of. It was down 70 something. Not much going on here. S&P is up 2.3 points. NASDAQ is up 33.9 points. So mixed kind of a day. The markets are at kind of record high territory, though. They're not giving up ground. And that is a very powerful sign that this market has a lot of legs left in it. It's going to go much, much higher. The stimulus program is having the effect that a lot of analysts were expecting, and that is that there is money flowing through the economy, and business is growing. People are being hired back. The unemployment numbers came out last Friday, very good numbers. And so the trend is in the right direction. The economy is revving up a little bit. There's a pent-up demand for a lot of people for goods, services. A lot of things probably been put off for a while that are now going to come in. It's springtime, and so a lot of projects around the house are going to get done now. All the economic conditions are there for economic uplift, and the cash is in the economy. There is enough cash flowing around the economy to make this work. And so the markets overall, I think, will do fine through the spring and summer, even into the fall. We'll see how this all plays out. But today, the market is not giving us a lot of incredible breaking developments. It's more of a consolidation day, more of a fill in and reestablish the new normal trading range from here. I think that these markets are just not shaky at all. They're not hanging on a precipice. No, they're forming a solid foundation to go higher from here. That's my hunch. I think corporations are going to start coming out with updates where they're going to say stuff like our second quarter financial or our third quarter, fourth quarter, we expect to post better numbers than we had before. Or a lot of companies who have not said anything in the last year as far as forward guidance is concerned are now going to start giving forward guidance. This is something that a lot of market players kind of want to know about, but companies have been, reluctant to try to predict future earnings simply because they couldn't predict whether their operations would be operating in all the U.S. states that they're involved with, or would there be new lockdowns? Would there be overseas shutdowns? All kinds of stuff. So all kinds of interruptions were in the air, and so companies are going, we can't tell you how much we're going to make next quarter or the quarter after that, because we're not sure what the economy is going to be like. We're not sure what the day-to-day environment is going to be like. But as each day goes by now, and more Americans are getting vaccinated, and the hope is that the virus counts will drop, more normalcy will return, and companies can begin to predict, okay, well, in our pipeline of orders and in the overall scheme of things, we think our earnings per share should be this or this or this over the next 2, 3, 4 quarters. And that'll give a little more certainty to this market. And the kind of projections that I think companies are going to be able to give are going to be the good kind of projections, the kind of projections that will show all of us that these market levels are not overinflated to an astronomical degree. The markets are high, yes, but are they too high for the economy and the earnings power of the companies? Probably not. And that it gets interesting, because if companies can justify the fact that their earnings next year or later this year will be higher than previously thought, or higher than 2 years ago, and higher yet again 2 years out, the current price earnings multiple won't be a big deal to worry about. In effect, the market will go, okay, the PE multiple of the market may be in the high 20s now, but for the year out and 2 years out, we're actually in the mid to low 20s. And there's upside potential for this market going forward. It is all about perception versus reality. It's all about expectation versus delivering the goods. And stocks generally trade ahead of their present day. If the thinking is the economy is lifting and a company will do better next year than current year, stocks will trade up now. They won't wait until then to start trading up. They'll trade up now in anticipation of the future earnings coming in. And then, of course, it's the show me next year. You've shown me this year, show me the next year. And if you can keep the momentum going as a CEO and as a corporation as a whole, the market is with you all the way. It's when you falter and you are priced to perfection, your stock is higher than current fundamentals dictate, and the fundamentals further out don't look as good as they do now, or what was perceived to be, then the stocks can take a big hit, and there'll be a reassessment by investors going, I think I'm going to get out right at the moment and reassess. The shares can drop 10, 20, 30, 40%, depending on the company. And then you have a kind of a consolidation, and the entity reinvents itself or reorganizes itself. Sometimes personnel pays the price. Other times divisions get dropped off, get modified, and then we're back on the growth track again, and you try to gain the confidence of Wall Street to move your company forward, move your shares forward. This is what it's all about. GameStop right now, 185.53 is where it's trading at right now, down $1.42. This is a very boring day for shareholders of GameStop who are used to a lot of action, a lot of movement. With sometimes a very tightly traded day is just what the doctor ordered. That's a good thing. Volume at 5.3 or 5.4 million approximately. Very little trading activity here. That's telling me that very few folks are looking to get out in a hurry, that they want to desperately sell. There's no real sellers here. You could also say, well, that means there's no real buying either. Well, fair enough. The shares are not coming down. They're not taking off. It's a quiet news day for GameStop today. They had all their activity yesterday. Although I have seen a number of articles today that came out that are talking about just how solid this stock is becoming. And this is, I think, reaffirming my hunch that a large number of Reddit readers, Wall Street Bets and others, who are following this stock very closely, they've been buying into this stock. And I think there is a huge number of shareholders that own less than 50 shares each. And I mean millions of people. And I think this is so spread the shares out over such a wide range, over a wide piece of bread, let's say. You've got butter being spread over a wide piece of bread here. There is no one area where you can grab a whole bunch of this stock by just chomping on one slice of bread. It's all over the entire slice, and it's very widely held. And this means, I think, there is an army of Ryan Cohen followers who have taken their positions. They're acquiring shares when they can. They see a down dip, they buy into the down dip, and they're just tucking the stock away. They're just tucking it away, and they're saying to Ryan Cohen, you just do what you've got to do, buddy. I'm there with you for the ride. The shares, we know you're coming up with new directors. We know you're coming up with new hires. We know you're evolving the company. But we know that at the end of, February, March, end of April, so the end of this month is the end of the first quarter. We'll hear the results of the first quarter sometime in May-ish, June-ish, just around the annual meeting. We know that's coming up in June. It'll be really interesting to see who the new directors will be. It'll be interesting to see who who new management will be, who takes on certain roles in the company. This is like a brand new refresh of the corporation, and these investors are ground floor investors. They've come in and they've paid various prices per share, and they like I said, there are millions of them, and I think there could be millions more following in the not too distant future. And it's going to be tough for any one institution to attempt a buyback of a bunch of stock. If they're short, if you want to buy back a bunch of this stock, you're going to have a tough time, because you've got to convince a whole lot of people to each sell a little bit of their stock, and that is going to take some doing. Not going to go at 185 a share, 190 a share. You're going to have to run this market up a whole long way to convince people to part with some stock. You got to show them serious profits. We shall see how that plays out. 185.47 right now on AMC. Not such a good day. The shares look like the letter U today, and at the end, the thing is falling off again. It is 10.22 right now. AMC down 38 cents a share. Volume of 39.5 million. Very light for AMC. Remember, there are about 400 million shares outstanding of the company. 400 million, and we're trading 39 million today. I think a whole bunch of shares are shorted. I agree with that, but the shorters are just not getting squeezed on this stock. They do not have any pressure on them to have to buy the stock up. And so at 10.22 here, down 39 cents, not looking good. The low of the day, $10. The high of the day was 10.50 first thing this morning. That was around the opening. But the best the stock could do at one point today, let me just check with my phone here. The best it was 10.35. Look at this letter U here. This is the opening here. And then it bottomed out for hours, had a little rally, and it's now fading, and now it's backing off again. Here in the last hour of the day, we have 49 minutes to go, and it's looking kind of tough right now. There was good news. There was positive news. There was interesting news coming out from the entertainment sector. Hollywood, new openings. Theaters talking about releasing movies. The problem, unfortunately, for AMC is that they have restrictions on their occupancy levels in certain areas of the country. It isn't completely wide open. And the other thing that's overhanging everything is case counts of the virus have been rising again in the U.S. here and there. And this is causing concern among health people. It's not what you want to hear. I'm sorry to have to keep bringing it up. I know you don't want to hear this, but it is bad news for those entities, those companies that rely on foot traffic to make a go of it. You have to have, in certain cases, shopping malls need people to come in. You need retailers that need people to come in. You need movie houses that need people to come in. If you don't operate at 100% efficiency, and the perception is in the next 3 months or 6 months, there could be more restrictions on people coming in, the investors of this world, as I was just saying a few minutes ago with other stocks, they price stock now at what they anticipate the company is going to be doing economically and financially. And today, people are saying on AMC down 37 cents. That is a big chunk of a pullback. This is not good. It is not a good vibe coming out of the market, despite all the positive news yesterday from Hollywood about Hollywood movie theater and movie counts and head counts sounded good, but AMC needs a wide open playing field to be able to do what they do best, to allow their patrons to come on in and enjoy 7 days a week. They've got to be showing movies 7 days a week, and they've got to have some serious cash flow to build back. So we'll see. 10.25 on AMC. Sorry to say, it's not looking great at the moment. The Dow down now 102 points. It is the low of the day for the Dow Jones Industrial 30. S&P is down 2.6, and NASDAQ up 8 points. So the markets are slumping a little bit here in the beginning of the last hour. See if this has much of a leg to it. We'll see how the close comes in the last 20 minutes. A few other stocks of note. IPOE up 31 cents today, 17.03. It was underwater this morning, broke even after about an hour or two, and has been had a little bit of run, and now is holding again. Gore's holding, slowly creeping up. It started just barely in the below water today, but it's now up 30 cents a share to 13.70. So a little bit of positive momentum on Gore's and on IPOE. Starboard Value is at $10, up 6 cents, and Fortress Value up 3 cents to $9.98. Over on Virgin Group, it's down 8 cents to $10.11 a share. Vanek Vectors today down 365 at 253. It's had a good run the last 2 weeks. I think there's a lot more behind that yet to happen. Home Depot just been hitting new all-time highs as of, I think, yesterday, new 52-week highs, down 153 to 313. IBM off $1.65 to 134. That's a solid, very, very boring stock. It doesn't move a lot. Buck and a half on a $134 company. Just doesn't move a lot, but it is solid. It's 168 on the downside to 134.25. The Dow right now down 98. That's what we're showing right now. The Dow for most of the day has been pretty flat. I mean, it's like I said, it's just down slightly. This is such a small, slight down dip considering the run it's had lately. Microsoft down 81 cents. You know, if you're gonna have a bad day, give me an 81-cent down day for a Microsoft. I can handle a down day like this. Apple up 57 cents a share. It was kind of at the flat line a little while ago, and now it's popped up a little bit. Low of the day, 125.65, and here it is, 126.48. The movement between the low of the day at 125.65 and the high, 127.13, buck and a half fluctuation on Apple for the whole day. That's it, barely 1%. That is telling you how quiet things are. Tesla up $2.26. Bed Bath & Beyond at $28.59, down 6 cents. BlackBerry down 26 cents to $9.04. And on the cruise side, still on the plus side, Royal Caribbean 90.80, up 165. Norwegian up $1.38 at 31.08, and Carnival up 43 cents to 28.54. Carnival announced today that they have canceled all cruises until July. Disney has canceled all cruises now until July. Norwegian canceled all cruises until July, but they announced that they were starting a cruise in Jamaica, Dominican Republic, and Greece with 3 separate ships, doing kind of what Norwegian and what Carnival and mainly Royal, I should say, Royal and Celebrity. They've announced that they're starting cruises. The Royal's going to start a cruise out of Nassau, Bahamas, starting this summer. They want to start another one out of San Martin in the Caribbean, and then I believe it was. Trying to remember if it was Celebrity. Somebody else was trying to start a cruise as well. I haven't yet seen cruises being mentioned to start out of Barbados. Barbados would be a natural place for cruises to start, but Barbados usually has had cruise ships from Europe do winter cruises from there, like P&O Cruise Lines from the UK. A bit early though. You generally don't start cruises in the Caribbean in June. You start cruises in the Caribbean in October, November. But the cruise lines want to get business going, and if they can't do business in the States, they'll do business elsewhere and avoid the U.S. completely. And maybe that's what's going on here. I still I contend that the cruise lines cannot make a go of it unless they have the U.S. market. Without the U.S. market, you're done for. Your costs are much higher. Fuel costs are cheaper in the States. Goods are cheaper. It's just simpler for cruise lines to operate out of the U.S. By the way, cheers to all of you. Thank you for joining me today. Here, Uncle Bruce with Stock Markets with Bruce, where we talk about the markets in plain English. I'm glad you're all here with me today. It's good to have you here. Cheers to all of you. Thank you for supporting this channel through the Red Bubble, picking up some items here. We love you for that. One thing that you might not know, the cruise lines, the 3 big ones, Norwegian, Carnival, and Royal Caribbean, with all of their subsidiary lines, they have production centers in Florida, where they have all these trucks come in with goods from all of their suppliers, and then when they're running, obviously, and then they have staff waiting to offload all these goods. They then divvy them up for each ship. They organize, what goes to what ship, pallets of goods. But they also have food preparation centers where they prep a lot of food for cruise ships on a just-in-time delivery system, where on the day of a departure, food will have been prepared in the previous 24 or 48 hours just for that ship's schedule, that sailing. And they'll bring refrigerated trucks in. They'll bring in trucks with they'll bring in goods that are all in vacuum sealed containers, and it goes right onto the ship, right into the kitchen area. The chefs are waiting to then do final prep on a lot of this food to start serving that night and for that cruise right away. All bread and buns and toast and everything is baked on board cruise ships, because the amount of space that a loaf of bread takes up once it's baked versus the ingredients of a loaf of bread, you can't imagine how many thousands of loaves of bread you'd have to deliver to a cruise ship. You can't do it. You just bring the flour and the sugar and the salt and the eggs and everything else, and the chefs on board, they prepare everything on giant sort of conveyor belt style ovens and systems, where they are cranking out enough bread and buns and everything else for 5,000 passengers and 1,500 crews, 6,500 people, a town of 6,500 people. You're cranking out the bread 24/7, including all the cakes and pies and desserts, all made on board. Only ice cream is brought on board. If it's hard ice cream, if it's soft ice cream, it's brought in a liquid form, and you just pour it into the ice cream maker and help yourself, grab yourself a dish or a cone and help yourself to an ice cream. It's incredible. It's an incredible machine. And there are, unfortunately, thousands of Americans laid off right now, waiting for the cruise lines to start up. And if these cruise lines are going to start up in the Bahamas, or in Jamaica or Dominican Republic or elsewhere, American jobs will not come back. These ships will not be serviced in any way by American workers. These ships will only be serviced by locals there. And again, it's a logistical nightmare to get a cruise ship set up for a 1-week cruise or whatever the itinerary is. You need everything from medication to food to supplies, detergents and soaps and fuels and everything else. And if you have mechanical issues, you have to be able to service your ship in third world type countries sometimes, depends, or you have to be able to get the ship to where it needs to get to be serviced. And in the meantime, you've got to figure out how to get your people looked after. And sometimes cruise ships get into trouble, passengers are stranded, and now we've got all kinds of problems. Anyway, it's the hope of these cruise lines that they can start sooner rather than later, back out of Miami, Fort Lauderdale, and Port Canaveral, Tampa, and other ports, but not right now, apparently. Anyway, there's a little rundown for you on a few things that I'm watching. The Dow down 95, S&P down 0.75 point, NASDAQ up 19, and GameStop 185.22, with more and more articles coming out about GameStop, talking about how the shares just don't seem to be giving up any ground, even with announcements like a potential 5% dilution of the company if they were to issue 3.5 million shares for cash. The sense that I'm getting from others out there is that the company has not yet raised any money. That yesterday, when we saw the shares open at 165 a share, within the first 10 minutes of trading, they were down to 165. That was not the company trying to sell stock into the market to raise money. That was just trading going on between hedge funds and other players. The word apparently is that the company has not issued any stock at all. They've not yet sold a single share to raise any fresh cash. They have the ability anytime they want to raise up to $1 billion for 3.5 million shares if they want to issue that many. But at this point, that hasn't happened from what I'm gathering at this point. I also read something else very interesting that I think you'd like. Was reading an article comparing GameStop to Chewy. And I'm looking for more of this kind of research and information. The analyst was saying that based on Chewy's numbers and trading range, and based on GameStop's performance, it wouldn't be a stretch to assume that not too far from now, GameStop shares would trade at $1,040 a share, based on a comparison to what Chewy is doing. It's now a moneymaker. It's got to turn the profit. It trades at a certain multiple of sales, and the estimations are for GameStop, as they convert over to e-commerce more and more, that they will also begin to be evaluated at a multiple of sales of some kind. And you compare it to Chewy, you've got a $1,040 stock. Didn't mind reading that. I also found it interesting that Best Buy is being picked up by analysts. It's being talked about. There are money managers out there who are talking about that they're buying into Best Buy shares, because Best Buy, being a retailer, also has an online presence, and their online sales are rising with in-store pickup arrangements, very similar to our friends here at GameStop with their in-store pickup policy with online sales. And Best Buy shares are being recommended by a number of firms for a higher performance price. So I found that interesting. It'll be very fascinating to see how, as GameStop expands their offerings, online offerings out further and further and further, how far GameStop can penetrate into the electronics market as a whole, as an e-distributor, as an e-seller. But I can say that we know that GameStop does have 55 million members of their Power Up Club, and they're all illiterate. They're very illiterate. They know how to buy online. They're used to buying online. They're used to spending online, and they don't mind clicking for a part or an order online. Don't even give it a second thought. Where in the past, I remember 20, 25 years ago, oh gosh, trying to convince people to buy online, people were so nervous that they were getting ripped off and that they would never get the product they bought, that their money would disappear into the ether. They didn't trust that the merchandise that would arrive would be the merchandise they wanted. There were horror stories out there. I mean, that's all yesterday's news. And today's customer for online sales they're fearless. They completely trust it. They completely have bought into it, and they're quite happy to send funds to an entity for a purchase, and they feel 99.9% confident they're going to get their merchandise, and they'll be satisfied with their purchase. And so this evolution of the world continues, and as each day goes by, there are fewer of guys like me around, the old timers, and more of you youngsters out there who are taking this world to the next level. It's just the way it is. Way to go. 184.91 on GameStop, trying to reach 185. What will it do for this last hour? It has been very flat here between 185 and 190 almost all day long. A very quiet day. No real movement on GameStop at all. Volume's 5.6 million shares. Volume. AMC now down 36 cents to 10.24, and 40 million shares traded on AMC. Not a good day on AMC. Definitely taking a big percentage hit today. 3+ percentage point drop. On GameStop, the percentage drop is 0.64. Just 2/3 of 1% is the drop on GameStop today. The shares are on a short sale restricted platform today, so shorters can't attack bids. But with only 5 odd million shares traded, there's nothing going on. It seems to me, as the days are going by, I'm kind of wondering if short sellers are tiring of this thing. They're just not able to make it drop, and they're getting less eager to hit this company's bids. Maybe that's what it is. I don't know. I keep thinking though that the smart money is on the sidelines waiting for the announcement of the directors, the 8 new directors that'll come into this company. I think a lot of folks are whispering, who do you think is going to be? Is going to be so and so? Going to be such and such? What companies might be represented? This could have a profound impact on the price of your stock. So we'll wait for that. All right. There you have it. Thank you for popping in here, everybody, and seeing me. Appreciate this as we come into the last hour. Short sellers are trying to get us to get bored, as says Eduardo. Exactly. Let's see here. Thank you. KW McKay, Keith Gill has 500 $12 calls expiring on April 15th, and most believe that he will exercise. Will this affect the stock at all? Well, 500 contracts represent 50,000 shares of stock. And in theory, if he decides to buy 50,000 shares at $12 for that purchase price, he's going to have to come up with $600,000. He should have no problem doing that. He will then force the sellers of those calls to deliver the paper to him, deliver the stock. Now, for a buyer of 50,000 shares, that shouldn't be a big problem. I mean, it's not going to take a long time to acquire 50,000 shares. Perhaps the mere symbolism of it all maybe is even as important or more important than the physical having to buy. 50,000 shares on the open market. If he had 5,000 calls and he was forcing 500,000 shares of buying, that might help a little bit more. But how many others with Keith Gill are there? That's the question. And maybe not at $12 a contract exercise price, but more at like, say, at 100 and 105 and 110 and 115. How many thousands of contracts this Friday, for example, are going to come up where a whole bunch of people are going to exercise their calls, and then next Friday again? It's like every week that these shares hang around at these levels, more and more contracts that were written, in the last month, 2 months, 3 months, 4 months, and back, all of these contracts are coming up in the money, big time in the money. To be fair, though, as each Friday will come down the road, eventually there'll be a point where very few $10 and $12 and $13 and $15 contracts will mature anymore, because no one writes those anymore. No one is now writing $12 or buying $12 contracts from scratch that expire a year from now. Today, people who are taking on option positions on GameStop, they're buying maybe 150s to 250s for a big chunk of the trading, and then from there the speculators are buying from 250 up to 500 a share, a bunch of those contracts. And then there are the uber gamblers who are buying call contracts from 500 to 1,000 a share exercise price, good for 6 months, 8 months, 9 months. And I'm sure there are market makers in Chicago accommodating these gamblers, because they always do accommodate these gamblers. So most of the option action, I would imagine you can take kind of like $25, $35, $40 on each side of this market price right now, but to around this 185 neighborhood. I'm going to guess that between 150, 140, 150, all the way to about 220, there's a lot of option action happening there. Whether people are writing calls, whether people are buying calls, tons of speculation for this week, next month, 2 months, 3 months, and so on going forward. The option market is active and usually hangs around where the stock hangs around. And of course, as I've been saying, we've been hanging around this neighborhood for a while. This stock didn't just get here from nowhere. It's been here a little bit, and now we've got this turnover and this kind of a comfortable vibe of the stock hanging around these levels lately, and a bunch of calls are maturing or coming up for expiration every Friday, well in the money. Heck, I would think that 2-3 months ago, when the shares were back down to $50, a whole lot of contracts were written at 50 to 60 to 70 to 80 to 90. Those are all maturing out this next few weeks. They're well in the money. So how many of those will be exercised rather than just sold back to the writer, and the writer takes the loss and the buyer gets a gain? How many short positions are being covered by these in the money calls that are coming up? Whether or not the shorter made any money or not is secondary. There are a lot of funds who were short stock. They were down, way down. They then bought in the money calls. The stock went up a little more, what have you, and now they're using the in the money calls to cover their positions rather than chase the market themselves from here higher. That's always a possibility. We'll see, guys. Lots to follow. Ferrigan, thank you for this donation. I've been very happy with my own evaluation. Now it's leaving me behind. How do you move your own price when the market moves above your comfort? How do you move your own price when I've been having my own evaluation, leaving me behind? I'm not sure what this actually. Don't quite get your question. I don't quite understand. How do you move your own price when the market moves above your comfort zone? The market moves up. You're talking about the whole market as a whole. Are you talking about one stock? Ferrigan, I need a little more help here. Not quite sure what your thought is on this. I was talking to earlier today about someone is asking me a question about how options deteriorate in price. How do you determine how an option breaks down in value as it gets closer to maturity? And I was mentioning earlier that one way to do it is to just look up an option market, even through the Chicago Mercantile Exchange. You can get free quotes if you're not part of an exchange. If you have a brokerage account, all of you with brokerage accounts can easily look up the pricing of options through your brokers. You'll be able to see option chains. Some of you might have customized scenarios where you can look up specific contracts, just $200 contracts or 190s or just all the calls, all the puts for that one strike price, and then you can see the deterioration of the pricing as time goes forward. I read an article again today, another one talking about how a lot of GameStop investors are utilizing their shares as a way to enhance income while they're hanging out, waiting for the stock to do what it's going to do, hoping that the shares do ultimately move much higher. And a lot of folks are utilizing, if you have 100 shares or more, they're utilizing the shares to bring in extra income by writing call contracts. And I've talked to a number of you about this strategy. I definitely encourage it if you're, if you're into the stock, you own a lot of it, you find that it's a large portion of your portfolio, or you would like to, be paid to wait while whatever's happening is happening. You can write contracts that expire this Friday. If you have 100 shares, this being Tuesday, you can write a contract that dies this Friday. You could write a $200 call or a $225 call or a $210 or $240, up to you. You might bring in $10, $12, $15, $20, $25 a share in instant revenue from a gambler that's prepared to gamble against you that the shares might go higher than $220 by Friday afternoon. There's always that strategy. Others of you who are thinking, well, I'd like to be a longer term holder, but I don't know how fast the shares will run up and where they'll run up to. You might want to write a 1 month or a 2 month call that is a $250 or a $275 or a $300 call, well out of the money, but yet bring in $20, $30, $40 a share depending on the contract right up front. If you get exercised out, you're getting taken out at $300 plus maybe a $40 premium. You're going out at $340 with the stock right now at $184. Up to you. There's all kinds of ways to employ this to generally generate revenue. Why would people buy a contract from you, though, is the question. People ask me all the time, why would somebody pay me $40 a share to buy a contract from me that's way out of the money a month from now or 6 weeks from now? And the answer is simple. For $4,000, they control your 100 shares for a set amount of time. It's a 100 share multiplier that they have in their hands for $4,000. And if they are correct that between now and a month from now, the shares will rise in value, they could profit nicely. Now, if the shares only moderately move from 185 to say $215 a share, and your contract is a 260 or a 280, they might make very little money. They might go from 40 to 45 bucks on the contract, and they might just sell out and say, I give up. It's not giving me my return. On the other hand, if they're buying from you a 3-month contract at $300 exercise, and the stock goes to 250 in the next 3 weeks, for you still won't lose your stock because you're $50 below the strike price, and you still get to sit on that premium you brought in. But for the person who bought the contract, they might be double, triple, or quadruple their money because that contract is now getting much closer to exercise, and there might still be 2 months' time left on it. That person could flip out and maybe take $4,000, turn it into 12, and have an $8,000 profit. This is how you can make very good money on a stock by holding an option. The trick of it is, are you right or wrong? If you are wrong, and with a month to go, you bought a contract 2 months ago, but there's a month left now, and you're still way out of the money, that contract might be down by 50% from what you paid for it, and you've taken a big hit on your money. Whereas, had you taken the $4,000 and just bought the stock at 185, where it is right now, if the shares are at $200 2 months from now, you're still up $15 a share on your original investment. So your $4,000 investment might be worth $4,350. You're up $350. You're not rich. You didn't cash in. You didn't make $1 million, but you haven't lost a dime. You've made money. And this is kind of the back and forth, the game that investors are trying to figure out. Should I buy the stock? Should I buy the contract? Which contract do I buy? What can give me the best bang for my money? And on the options selling side, the writer has to ask themselves, well, what contract should I sell? Should I be really close in to expiry for this Friday, or maybe just next Friday? Where should I write the contract at? What should be that expiry price? What gives me the best bang for the dollar, or what gives me the most likelihood of success that the call contract that I'm writing will expire worthless and I score the entire premium on this deal? Or can I write a contract this week that I can buy back next week, where I received, say, $20 a call, and I can buy it next week for $5, and I score my $15 a share touchdown on a 5-day, 7-day time turnaround, and I'm being paid $1,500 for a week. 100 shares, $15 a share, $1,500. I made a $1,500 gain on my position, and I still have my stock, and I can now rewrite a new contract for 2 weeks out, but I'm going to hold that, only going to be naked, that I'm going to be short that contract for only 1 week. I'm not waiting until the end. So in the next week, I watch it shrink $1 or $2 or $3 a day. And for every 100 shares I have, I'm generating a gain of $100 to $200 to $300 a day per day on my position, on my contract. And after 5 days of $3 a day shrinkage, I'll buy it back and score another $1,500 gain. A lot of people do this kind of thinking and guessing and surmising, to generate revenue from their portfolio, to not be just sitting there with money invested and watching the time goes by. There's all kinds of this sort of stuff. Anyway, there's a lot to think about, a lot to wonder about. Thank you for using these emojis, everybody. Appreciate that. Should you buy stock on margin? I saw a question about a margin question. Is that a good idea? There are times where buying on margin can come in handy, but there are times where buying on margin is not a really good idea at all. Nowadays, the good news is, depending on the firm you're using, you might be able to buy stock on margin for very little cash, for very little percentage cost. The thing, though, is to understand is that when you do buy stock on margin, you are taking on much higher risk than if you're just using cash only. A perfect time to buy on a margin scenario is if you own stock already, and let's say you own GameStop here at 184.53, and tomorrow, an hour into the day, the market is 185, 190, and it's starting to move up a little bit, and the company has made an announcement of a couple of directors that are being nominated, and the market likes this news. You might buy on margin an additional bunch of stock on top of what you have to flip that stock that day. In effect, the stock is 190, and your thinking is that it might reach 200, 210, 215 a share that intraday. You've got 100 shares, let's say. You buy 50 more, 70 more on margin. The stock does go up $15, $20. You drop those shares that you just bought on margin and take the margin gain, the gain on the stock from that 190 to 210 ballpark. You made a $20 gain on 70 shares. Thank you, $1,400 in your pocket. It was an intraday loan. You at the end of the day, you still hold your stock. You're a happy guy or girl. That's one way to play a margin account, is on a momentum run that is working, but you have to pull the pin quickly to get out. Another option, a strategy some people will use, is they'll buy stock on margin, and as the stock moves up, say intraday or 2 or 3 day run, if there's a sustained movement up, then they go to sell the stock that they borrowed against, but they only sell enough shares until the balance is paid off in full. So if you have 100 shares and you buy, say, 70 more, and they do go up in price, you sell enough stock at the higher level until you don't owe margin anymore, and now you have 115 shares, all bought and paid for, because you don't owe any money on the remaining 15 or 10 or 7 or whatever shares you got left, and you're slowly building your position this way. You're trying to catch momentum moves on the upside to take an option position, let the stock take its $5, $8, $10, $15 run, sell off enough shares to pay your margin down to zero, and now you've increased your shareholdings again. And slowly you're building your position of the company by using momentum swings with marginability on top of just just sitting there watching your stock move up and down. These are strategies that people do employ. There are others, though, who are out and out gamblers. They use their credit cards and they take cash advances. They throw the money into their brokerage account, and then they buy their favorite stock, whatever it is, and they borrow against it to leverage up. And they've now got borrowed money at 22% interest from the credit card company, borrowed money from the broker on margin. They go long on the stock, and they better be right, because if the stock goes down, they get a margin call. And if they can't come up with additional cash, they now have to sell stock at a loss, which means they end up with even fewer dollars than they started with. The losses are volumed up. They're compounded losses. You don't want to get caught in that game. But unfortunately, a lot of people do get caught up in this game because they feel that they can't lose on a position. They are so hyped up. They want to get into it, and they load up with everything they can find to get into a deal. They margin it up to the max, and lo and behold, they're winning for a while, and then they got a bad day and they get wiped way out, where they go from a position that was once worth say they put in $5,000 cash, they had 10 grand with margin, they got up to 20 grand total value, and 3 days later they're at 5 grand total value. They've lost 15 grand because, again, the amplification of the losses on margins can be devastating. Now they're sitting there with only 5,000, or they're sitting with 3,000. They're not even their original stake anymore. They've gotten wiped all the way down, and they owe this credit card company or whoever they're borrowing money from to play this market. They owe that money plus interest, and it's an ugly scenario to have. You don't want to get caught in that game. That is not investing. That is gambling to the maximum extent that you can gamble, and I would not recommend it whatsoever. It's just an old guy talking about the market. What can I say? Thank you, everybody, for being here. Appreciate this. Bruce, Uncle Bruce, who in the world do you think is buying 1.4 thousand, is that 1,400, $690 call contracts expiring in 3 days? Who would want to buy that number of call contracts? The only guess I have is that it's an extreme gambler that somehow seems to think that between now and Friday, the shares could have a bit of a run. Maybe even tomorrow that the shares run up $60, $70, and the calls that they're buying go up by 50%, and they're just going to flip them. That could well be it, but who's the buyer of that call, I ask you? Is that just the writer who's going to buy them back? Who's going to buy back a call contract with 2 days to live instead of 3 days to live that are still way out of the money? I don't get it. I can understand where there are call gamblers buying call contracts with, say, $220 call contracts for this Friday. 3 days, they're approximately $35 out of the money. I can understand how someone would be long calls for 3 days thinking that this stock can go to $210 a share on the opening tomorrow morning. We've seen it before. We've seen pre-markets, after markets do all kinds of wild and wacky things. And the thinking is that the shares might open at 210 in the first 15 minutes tomorrow morning. And the calls that they're buying now at whatever price they're paying could be double or triple the value tomorrow morning. And so there's gamblers willing to take that chance. There's gamblers everywhere with all kinds of dollars that are comfortable to them that are uncomfortable to us. Some folks are comfortable trying to flip 15 grand in 3 days to 100. There are others who wouldn't flip 1,500. There are others who won't flip 150. It all depends. Now, these contracts here you're talking about, I have no idea what they're trading at, but they can't be very high. They've got to be so cheap that there could well be a gambler just thinking, hey, if these go from where they are, they might go up 5 times their value with a $100 move on the stock. I don't know. I don't get that mentality myself. It doesn't click with me. I can't tell you how this is going to work. It's a world of which I am not familiar. Anyway, what can I say? Hey, Bruce, any tips on finding new stocks to write covered calls on? A lot of people talk about writing them on spiders, but I don't have the 40 grand to buy 100 yet on that. If you want to experiment on writing calls, There's ways to play this game at every level. I mean, nowadays in this world of ours, one of the advantages and one of the one of the neat things that have happened is people out there can play the option market with less than $1,000, and they can literally play the I'm going to write call options with only $1,000 or $1,500. And here's a classic example. I mean, you could buy AMC shares right now. You could buy shares of AMC at $10.20 on the open market. And you could turn around right now and write an $11 call contract against the stock. Let's say for a couple of weeks out. And I'm not sure what you'd get for it. I'm not sure what kind of premium the stock would give you, but I bet you could write an $11 AMC call for 2 or 3 or 4 weeks. That'll probably bring you in $1. And you're bringing in $100. You're spending $1,020 to buy the stock, but you're getting $100 back to write a call good for 11. The stock goes up to 12, you'll be exercised, but you sold at 12 because you get your $11 plus the dollar you got. You sold at 12. You've made $1.80 on a 10-20 investment. Is there anything wrong with making that kind of money on money? No, there's nothing wrong at all. On the other hand, if the shares sit here at 10.19 and only reach 10.20 or 10.80 before the call expires, that $1 is yours, and thank you very much. If the shares go down to 9, that call contract will drop to 25 cents pretty quickly, maybe sometime in the next week and a half, well before it even expires. You could then buy that call back and turn around and write a $10 call for maybe 2 or 3 weeks out, bring in another $1, and sit on that contract. Now, you bought the stock for 10.20. You made 75 cents on the first call, so your cost of the stock now is $9.45. You're now writing a $10 contract for $1. If you could score the entire dollar, you're down to an $8.45 cost base on AMC. If the shares don't go over $10, you won't be exercised. They'll die worthless. If the shares stay between $8.50 and $9.50 for the next week or two, that call you wrote for $1 will be worth about 25, 35 cents. You can buy it back, score your 60, 70 cent gain, and turn around and write either another $10 contract that has more time on it, or a $9 contract, or whatever option you can find. I'm not sure if they traded 50-cent increments. You might be able to write 10.50s or 9.50s. You'll write another one. And you can play the option market on as little as AMC. You can play the option market on a stock like Sundial. You can buy stocks in the $2, $3, $4, $5 neighborhoods and have 100 shares and write call contracts. You're not getting rich, but you're getting experience. You're learning how it works. You're getting familiar with the program, and you may then decide to step up to a more expensive play to try to bring in some actual cash that will make you real money. But with these machines and the trading platforms that exist now, where you can free trade stock without paying a commission, you can write call contracts, buy call contracts for very little commission per contract. In some cases, 50 cents a contract. You could try to make money doing this. It's something that you have to ask yourself: do you want to try that in this limited way or not? But yeah, with AMC, look, if you've got $5,000, you can buy 5,000 shares or 500 shares of AMC, and write 5 contracts. Knock yourself out. But the upside of the stock versus the income you're bringing in, you might find that the shares don't go very far overall. They fluctuate between $8 and $10 and $11 a share for a while. But over the next 6 or 8 months or next year, you might be in a position to be able to write contracts against AMC every month, twice a month, for 6 or 8 months. You might write 12 or 15 contracts against the stock. And if you can average 50 cents net return to you on each overall situation, and the stock doesn't move for you, you've brought in $6 a share on a stock that's still sitting at $8 to $10 a share. You've made a nice return on your money. And you haven't bankrolled your entire existence against it. I mean, if you've got the $5,000, you've got the $5,000. In the case of GameStop, to get 100 shares, you got to put up $18,000. That's a little more money, and so you deserve a higher premium for offering a contract. But you know what? If you've got $12,000 and you borrow $6,000 from the broker on margin to buy 100 shares of GameStop and now offer a call contract for $20 a share for a 200 that's good for 2 weeks or whatever the price of these options are. I'm not telling you that's what they're trading at. I'm guessing. You have to look this up yourself. But if you can bring in $2,000 or $3,500, $35 a share for an even juicier return, you can put that against your margin on buying this stock. And the whole objective is you want to own your 100 shares cash on hand. So you borrowed $6,000 to get it. You wrote a call contract against it, and if you could bring in every week or two $10 or $15 a share on option depreciation, that goes against the $6,000 you borrowed to buy the stock. And over 4 or 5 or 6 weeks of time, give and take the fluctuation of the stock, you may have paid off your margin debt. And now whatever the value of the shares are is your value in your account. Now, if the shares are 185 and that's what you paid for them, you got an $18,500 account that you originally only put up $12,000 to get into. You're up nicely, 50% on your investment. If the shares were trading at $150 though, they've dropped. You have a $15,000 account, but you only put up $12,000 of your money. You're still up $3,000 on an original $12,000 investment. That's a quarter of your money in a 5-week, 4-week, whatever week time frame. If the shares, however, have gone up to $220, you have a $22,000 account that you only put up $12,000 on. You're up $10,000. You've added money from the option premiums you made, and the stock went up as well. You've gained capital gains. It's all a question of how you play this market. How active do you want to be with this market? How closely are you going to follow these trades to be able to pull the pin to either write a contract or buy a contract back and then rewrite a new contract? You've got to study and do your homework. That's what hedge fund managers do for a living with billions of dollars. You can do it with thousands. It's up to you how to do it. The market is coming into the close. We're at 12:56, 4 minutes to go to the close, 3:34 until we shut the market down for the day. The Dow is down 130 points, which is towards its low of the day, unfortunately. S&P is down 8, NASDAQ is down 22. That's where we are right now with the stock. And again, I don't know if you can hear noise in the background behind my voice. There is some kind of a sewage issue happening across the street from our house, and there's a pumper truck making a racket like you can't believe. I don't know if it's translating here. I hope it's not bothering you too much. I appreciate you being here. Michael, say you're up 75% on a covered call Wednesday before the expiration. Is it a good idea to buy to close? You've written a call. Should you buy it back? You may lose that 25%, but low risk. Well, this is something that people are wondering about. I usually say this: if you wrote a call, and you're up 75%. Let's just say you wrote a call for $10. And it's now trading at $250 because you're up 75%. You could theoretically buy that call back today, lock in that game, turn around and write a new call for the next Friday. So that if this first position was only a 1-week position or a 2-week position, the new one could be the same thing. So theoretically, you could look at next Friday's price of the same call, the same exercise price, and ask yourself, look, if I hold this for 2 more days, I get this much money. If I write a call for next Friday and I hold it for a week until next Wednesday, how much will I generate on the shrinkage of this contract? Is it more than the daily return that I'm going to get on the remaining value of this contract that I still have? Or am I better off writing this new one over here? Which way should I go? That might be something that will determine which way you go on it. On the other hand, you might decide, well, I want to go out 2 weeks. I want to go out 3 weeks because the contract I wrote here at $10, I wrote 3 weeks ago. I might do the same thing further out. It's up to you on that. But the return for the last 2 days, you've got to ask yourself, is it worth it for me to still be the shorter of this call? Should I just buy it back now and end it and then write a brand new call position further out from a Wednesday to a Wednesday consideration? Because a lot of people make the mistake of trying to play option expiry day as their expiry, where others say, no, I'm going to use Wednesdays as my day. So that way I don't get caught in that last 48-hour wild gyrations that could catch me offside. Wednesdays are the day that I buy back. Wednesdays are the day I write. And I like to write for 9 days out or 16 days out or 23 days out, depending on the stock you have and your risk tolerance. That might be the way to go. Thank you, Mike, for that question and donation. I just like the simplicity of buying and holding. I hear you there. Risk versus reward. I hear you there. Absolutely. Bruce. Hi, Bruce. How do you feel about the 3-3 rule when buying options? 3 months out plus $3 premium. Thank you. Again, time is money, and it is so evident when it comes to contracts. Time is money. The more they have to live, the more they cost you. It's just that simple. We have closed for the day on the markets. GameStop 184.31 last trade. The bell has just gone off. Down 264. I can handle these fluctuations all day long. 184.70 so far on the aftermarket, up 39 cents. Early indications of the aftermarket. These contracts are a true reflection of time. The longer they have to live, the more they cost you to buy, or the more you get from a premium sale, from a sale of a covered call. But you'll also note that a contract, a call contract will have a higher premium on it the more volatile the underlying stock is, and that's GameStop. GameStop's reputation is it can plus or minus 10% during the day, normally, not today, but normally. And call contracts and put contracts will have high premiums because of this. And so as a writer, if you're a seller of a call to the market, you can haul in a wonderful premium to write a call contract, knowing that the stock can go up or down 10% in one day. If you're very attentive to the stock, you're watching it very closely, and you write a call contract that expires next week, Friday, at say $200, you'll get a nice premium for that contract. It's within $16 of the market. The stock can reach that price intraday, no problem. You also, however, know that, well, if I write this 200 and the stock goes to 171 tomorrow during the day, I can buy that call back at a lower price because it's now $29 out of the money temporarily. Is the stock going to go lower than that, or is it going to come back to 194 or 185? We don't know, but you're an option writer. You've got two minds now. You're thinking, I'm a long-term holder of the stock, yes, but I'm also interested in being a short-term shorter of the stock via the options market by writing a call against it out of the money, 200, and if it goes down into this 171, 72, 73 neighborhood, that call that I wrote for maybe $20, I can buy back at 12. I got a quick $8 in my pocket if I take this deal. And I can now sit back and just say, all right, I got the stock. I'm a long-term holder. I'm not fazed by the fact that it's down to 172 a share. Comes back up to 180, 83, 84. You might choose to write another call yet again. And it could be the same exact call you wrote the last time, same exercise price, same exercise expiry date, or not. You will pick the one you want as you see the stock do what it does. Volumes of trading and the trading range of the stock, news coming out, what's going on. You decide every time which call you want to write, for how long and at what price, and are you happy with the premium. And then you predetermine in your mind, if this backs off a little bit, or as each day goes by, this contract shrinks on me, which it will, as the time is your friend now, the clock is your ally. This contract will shrink in value, and if there's a bit of a pullback on the stock, it'll really go down. And that's where you are waiting to buy it back. You're the accommodator. You're happy to buy it back because you're locking in a gain yet again on another option sell. The stock itself, it fluctuates. It moves up and down, moves up and down, but you're a long-term holder, and you're utilizing those share certificates as your asset to make money. It's your retail store. That's what it is. It's your casino. You own this casino, and now you're just trying to write against the casino. That's all you're trying to do. And if you buy into that, More power to you. Do you think SOS is following game pattern, GME pattern? I don't even know what SOS is. I have no idea. Excuse me. Let's go here. We are taking a look here. DFV tweet, we are not alone. A lot of comments here are folks talking to each other, which is cool. Great about that. It's just a Tuesday, says buy and hold. It's just a Tuesday. Bruce, I love you, following you, watch you all the time. Do you have a personal vendetta against GameStop shorters from your past? No, not really. Look, I'm happy that people make money in the market, and if you want to become a shorter yourself, you want to play the I want to be paid to hold stock game. You can do this with GameStop. You can do this with AMC. You can do this with any other company if you want. You could write calls against SPACs, but I wouldn't recommend it. I would not write call contracts against your SPACs until well after they do their deal. Let them do their deal. Hopefully their stocks will have a little run. Then you can be an option writer at 25 or 30 or 33 or 40 or whatever the market tells you to write them at. More power to you. You can always buy IBM and write calls against IBM. They're boring to write, but they're wonderful when they expire worthless. They're fantastic things to write when they die for zero. Same thing with Microsoft or Apple. I mean, 100 shares of Apple can be acquired now for $12,600. Write a call contract against Apple and bring in an income. You can always do that. You can do it with BlackBerry at $9 a share. You can write $9.50s or $10 against BlackBerry. It's a $9 stock, 100 shares, $900. You're in the options market. You can play the time game with options contracts as a writer against virtually any stock out there. And there's ways to get into this business to generate revenue, and there's nothing wrong with that. Thank you, everybody, for being here and hanging out with yours truly. I appreciate it. Calls are going to go wild post-merger. I think there might be some fun there. We'll see how this all plays out. You should make a video for beginners. Options, lead us dummies to understand options. I've been thinking about something along these lines. I do a lot of one-on-one consultations every weekend, and I really try to help a lot of you individually figure out the option by just explaining it in a real simple term. And we look up options values together, and we kind of see what they're doing. And this is what I do a lot of. It is a different world unto itself. It is related to the market, but it is separate from the market. Chicago is where they trade options. New York is where the New York Stock Exchange is located, where the shares trade. NASDAQ is where they trade on NASDAQ. And the options mirror or oppositely mirror the shares. But there is that time factor that is involved in this. That's what futures are all about. That's what options are. They're a form of futures. And there's a risky way to play the futures market, and there's a conservative way to play the futures market. And being a writer of call contracts is a conservative way to be in the options market, and let the clock be your friend and your ally in this entire deal. There you have it. Thank you, Ona. Thank you so much. Appreciate that. I love you too. Let's see here. Chino says, I bought FAII April 16s for a nickel for fun. You can buy option contracts for $100, $50. I mean, you can do that. Control 100 shares of a stock for not a lot of money. And it's true. These SPACs that I talk about these 7 different SPACs all the time. List them as my, here in my banner right here. Here we go. There are all these stocks that I follow, and there's GHVI and VGAC, and in the very bottom of the list, there the last 5, you'll see IPOE, NSH, VACQ, FAII, SVAC. You can buy call contracts on all of these SPACs if you wish, and you can pick up call contracts that expire maybe in May or June or July. If I would go that's how far I would go out if you're going to buy call options on these. And you can buy, depending on the stock, you can buy call contracts that are 10s, 11s, 12s, 13s, 14s, 15s. and speculate on how the shares will do once they merge their companies together and trade on the open market. So if you're a fan of Gore's Holdings, or you like the IPOE, for example, that's soon to become SoFi, soon. You can buy SoFi or IPOE $20 calls several months out. You can, in the case of this one, you can buy probably calls that are going into May or June, because I think this merger should be done at any time. You will own SoFi calls. That's what they turn into, one for one. So if you have one IPOE call that expires in June, you're going to have one SoFi call that expires in June. It's just a name change. But if the SoFi merger leads this stock to the $25, $30 neighborhood, and you've got a $20 call contract, and you're at $10 in the money at $30 a share, you could turn a nice little investment into some cash. But you're taking a chance that you could be wrong. You have a time limit for a result. But if not IPOE, how about picking up Vector Acquisitions? Vector Acquisition Corporation is $10.99 a share. You can buy call contracts on this one for 12 or 13 or 14 for months out. Same thing. Or you can pick up pick up Virgin Group, the VGAC. It's 10.06 is the stock price. If you believe that the chances of this stock hitting $15 to $20 a share are reasonable upon a completion of the 23andMe merger, with $950 million going into the treasury of 23andMe and all the announcements, and Richard Branson being the spokesperson for this new deal, you can buy into contracts with this stock for very little money. Going forward, I would say into Mays and Junes and Julys and Augusts, I would take a look at those. I wouldn't even dissuade you from picking up 12s or 13s or $14 contracts. If you can get them for cheap, say they're trading at a quarter, you're paying $25 for a contract. You can buy 10 contracts for $250. You control 1,000 shares of this company at, say, $14 a share or something like that. They go to 20, they're $6 in the money. That's a $600 contract times 10 contracts. You just took $250 and turned it into $6,000. That's leverage. That's available on these kinds of deals. It's something to look into. If you don't have tens of thousands of dollars to invest, or you do, but you also want to have a little bit of action on the side, you want to throw $300, $400, $500 at each of these SPACs through an option program. You might pick off $200 worth or $250 worth of these contracts for this stock, and $250 worth of these contracts for this stock that have a different time frame or have different exercise values, and you're leveraging up a lot of stock, waiting for the merger to go through, and you're just going to sit back and say, okay, go ahead and merge. Tell us all your plans and make press releases every week, and the contracts will tell me when to sell them. This stock goes, these contracts will go too. Thank you very much. These are deals that are out there you can try to take advantage of, where you don't need thousands and thousands of dollars to buy up a bunch of stock. You can do it with hundreds of dollars to control a bunch of stock for a limited time frame, awaiting the merger to go through. For sure. It is another thing to consider and to look into. Just your Uncle Bruce giving you ideas. Anyway, there you have it. I have to learn how to do calls. You do enough times, you can get rich. Let's see here. I do it once or twice a month on IBM, Apple, and a few others. I'm assuming writing contract. Let's see. I've always bought and held stock. Gotta play smart. And let me move up on current comments here. Thank you for these comments, everybody. Let's go. Hang on. A bunch of comments have come through, and I'm behind here. Sorry. Excuse me. Here we go. Okay, here we go. AB. Can't wait until I have 100 grand in an account and then buy a SPAC the minute the merger is announced and make 10 to 20 grand at the bell, then buy back in at $9.99. Well, I'm not sure if that'll happen. Parables. Hey, Bruce, what's your thoughts on Canoe NASDAQ, GOEV had a crash at the end of March, but slowly recovering. I don't know anything about this company. I have no idea about what they're about. Let me read this comment here. Randy, how does Sykstra's 1.2% market share impact you being bullish on SVAC? Equinix, California data provider in the same sector, is number one, sitting 11.1. Can Sykstra be a formidable competitor? Well, Sykstra has 61 data centers, and so this shows you how little they are in the big scheme of this business, and so they have a lot of room to maneuver. I'm wondering, and I'm kind of thinking what they're going to do here is once they are, publicly traded, they're going to use their shares as currency to acquire other players that are private. And they will slowly but surely amass additional data farms. They'll find money that they'll be able to raise too. There will be investors willing to invest money into this company because they're liquid. They're publicly traded. I think they're going to attract a lot of investment at 15, 20, 30, 35 a share and beyond. I really believe it. There will be private players who are too tiny to go public on their own, but they can go public becoming part of this company here. That's their ticket into the public market. And I can see where Sykstra will come up to and say, hey, look, we have 61. You've got 10. Why don't you become part of our company? We now have 71 combined centers, and we will combine our business plans and we'll grow out from here. Then they'll approach another one with 5 or 10 or 20 server farms, another one over here with 10 or 15 server farms, and slowly but surely they'll cobblestone together enough of a company where they might have 150 to 200 data centers, triple to quadruple their current size, getting into this 250 range. The shares could well be at 50, 60, 80 bucks a share at that point in time, flowing a lot of money. That's the upside of this kind of a deal. You're a ground floor investor in a brand new ground floor business that is a big cash generator. And you know, and I know, the data farm business is not a shrinking business. The data farm business over the next 5 and 10 and 20 years will become extremely much larger than it is now, because every single business needs the capacity of a data farm with all their service for all their data security and everything else. So this is an area that I would definitely look into. And from a SPAC, to get into it as a SPAC, I think that this is where you want to be. That's just I think this is the price point you want to be in at. I like the deal. I think that's, what is that, Starboard value? Is that one we're talking about? SVAC 1002, man. This is ground floor, absolute ground floor. Welcome to the IPO market, a ground floor investment. Rather than being the last guy into the stock, be the first guy into the stock. That's my advice to all of you on these deals with these SPACs. Now, whether you're buying them straight out as stocks, whether you're going to buy call contracts at very cheap prices to jump into and control 500 shares or 1,000 shares for a few $100s, there's ways to get involved in these companies for not a lot of cash. But it's a limited time frame, because once they announce their deals, they're on their own, they're out there now. And maybe you still have some time after the deal is announced. Maybe Starboard only reaches 12 or 13 bucks a share for a while. Maybe it's not a big splashy start, and then you pick up contracts for 3 months or 6 months or what have you. Maybe. On the other hand, if Starboard has deals pending that they're already negotiating or that they believe they can pull off, it could well be that they've reached, they've already been approached and have already solidified billions of dollars of cash from a number of serious investment entities in New York and elsewhere to go into this company to allow them to expand out. And they might be able to do bond offerings at 1% interest for billions of dollars to acquire competitors of theirs, between using kind of cash and stock to buy them up. And they might go from 61 server farms in the first week of existence. Within a year, they could be at 150, 350, 500 server farms and be a much bigger company, and will leave this $10 stock price way behind. It's wide open, but this is ground floor. This is it. This is the bottom, as far as I'm concerned. I think this stock in the $10 neighborhood is as good as it's going to get. You've got to decide how you want to play this market going forward. Anyway, that's just Bruce being Bruce. We're going to be following this. Let's see what's going on. Let's see what else is going on here. Great question, Randy. Rupert is saying, I think there's a lot of room for competition. I know Equinix just bought a private DC in Toronto when they already had a DC here. I agree with Bruce. DCs are growing. Let's see. I need some UBIs. Uncle Bruce Investments. Hi, Bruce. How do you feel about the 3+3 rule? We just did that. Mad Cow. Uncle Bruce, why does everyone seem to shy away from writing put contracts? On January 27th, when things were nuts, I wrote a cash-covered GameStop 50-cent puts expiring April 16 for $7 each, 14% return in 3 months. I think what it is, Mad Cow, is you're dealing with the short side of the market. You're dealing with an instrument that people don't relate to. Most investors, 98% of investors think one way: buy low, sell high. That's the way they are. They're it's how we're trained. You start off in university as a high school graduate. You come out with a master's degree, and you go from a KFC job at $8 an hour to a job with a real company at $38 an hour. I mean, it's buy low, sell high. We only accept losing in the car market. We buy a car for $35,000 and we expect to sell it for 10 grand down the road after we've beaten the crap out of it. We accept that. But with a house, you expect to buy a house for a set price today, and then down the lane, a few years down the road, eventually you expect to sell a house for more money because you just expect houses to go up in value all the time. It's just how we're bred, how we're programmed, what's in our brains. And so the same thing with options. Call options go up when stocks go up. Generally speaking, that's how it works. Put contracts go down when stocks go up. Put contracts go up when stocks go down. And very few of us are programmed to think in the reverse. And this is where you're having a field day all by yourself to take advantage of some opportunities that have come your way. And you've done your homework and you figured it out. I try to tell followers of mine that you can be a shorter of stock by writing call contracts and taking away all the risk that the call buyer has to assume when they take on a position. Call buyers have to take the time risk factor into account when they buy a contract. They have to take into effect the fact that they might hold a call contract that's out of the money or could be out of the money by the time it expires, risking everything, where the writer takes the opposite side and uses it to their advantage. The key here is you should be an owner of the security when you write call contracts. And so if you own 100 GameStop and you're offering a call contract against it, I say good for you. Take a nice fat premium and go nuts. There's nothing wrong with doing that. Absolutely nothing wrong at all. The next call contracts that expire are coming up April the 9th. That's this Friday. And right now, if you want to buy a call contract that is a 185, you got to pay $7.80 a share. You want to buy a 180 call, it's $10.50 a share to buy it. But if you're a seller of that contract, you can sell it for $10.50. And in 3 days, it dies worthless if the stock stays under 180 a share. The 185 you can sell right now for about $7.80, $8. The stock does not hit 185 and be beyond, you get the $8 for yourself, all your money. Looking forward, if you want to move up in time to like next week, Friday, the 16th of April, you can play with a 185 contract, for example, a call contract. Those are going for $16.70. Let's call them $17 a piece. So you can buy a 100 share ownership position or control 100 shares of GameStop for $1,700 by buying one call contract that expires next Friday. If the stock goes up to $230 by next Friday, this contract is worth $45 or $4,500 in pure value. That right there is a nice little gain on your position. On the other hand, If the shares are 184.50 next week, Friday night, you've lost all $1,700. And this is where the seller of this call contract is looking at it going, I could offer 100 shares of my GameStop shares to this guy for $1,700. And if the shares are sitting at 180 to 185 by next Friday, I score all $1,700 and I don't have to do anything. Not a bad way to go. On the other hand, the 185 call contract that is expiring in 2 days and 3 days, as I was just telling you, is trading at the low price of, what was it? $7.80. Call it $8. So this contract will lose $9 in value between now and next Friday if the stock is exactly where it is right now, a week from now. That is the gain that you can be given on a silver platter, $900 gain for 100 shares of GameStop. The gamble as the writer is the stock could go up on you. The gamble as the buyer of the contract is the stock doesn't go up, goes down, or doesn't go up enough to let you make any money. Those are the gambles that both parties have to assume. That's what makes the option market so exciting. If you want to play with a contract that expires in April 23rd, 2.5 weeks from now, let's say what would that be? A 187.50 contract is approximately $23 in premium. So it's very expensive to play that. But that's a contract with more time. You've got to pay for time. That's the deal. You want to go with the April what's that one? April 30th, the end of the month. A 185 is $28, $28.50 for a 185 that goes until the end of the month. So there you have it, $28 of risk for the buyer, $28 of income for the seller. Now, if you're a writer of a contract for the end of the month, you can write a $200 call contract and bring in right now $23 a share. You want to write a 220, you can bring in $17.50 to $18 a share to write a 220. That is out of the money, $35 right now for the end of the month. Nice return. On the other hand, you write a $250 contract for April the 30th, you'll bring in right now $12.50 a share. And if you get taken out, you get taken out at $250 plus the $12.50 you just received up front. That's actually selling your stock for $262.50 between now and the end of this month. Would you be happy with that kind of a return? Someone out there can buy 100 shares of stock at 185 and immediately write a 250 call against it and could theoretically be paid $262.50 by the end of April for this 185 purchase price. I don't know what's wrong with making $6,000 on your money. That's a third on your money writing a call contract for 24 days. Today's the 6th of April. It's a 24-day contract. Make a third on your money, 33% return in 24 days. Where can you get that from anywhere else? Now, the only way you're going to get that is if you get exercised, or if the shares go up to $245 and you don't get exercised, you're happy because you're up $60 a share, because you bought at 185 and you pulled in the premium of $12 and you get to keep that. So in effect, you're ahead 70 some odd bucks on this whole deal. Very nice return indeed. Now there are people out there, again, gamblers, who will buy the stock on margin. They will put up half the money or 60% of the money. So they're going to get 18 grand worth of stock, 18.5, by putting up maybe 10 grand cash, borrow the rest from the broker, write the call for $250 to the end of April, and sit back and go, okay, let's see what happens. If this stock goes up to 250 or 245, I won't be taken out. I get to keep the $12, and I'm worth $245 a share from 185 a share. I made $6 grand on the stock, and I made 12 grand on the contract. I'm up $7,200. I only put up 10 grand. I'm up 72% on my money. The broker, I owe the broker the difference between what I bought the stock for and what I put in. I put in 10 grand. I paid 18.5 for the stock. I owe my broker 8,500. The 1,200 cash I got in just went against the margin call or the margin balance. Now I owe the broker 7,300 in cash, but my portfolio is worth $24,500. I am way ahead. That's how people play the market, with margin and contracts. to try to make more money. But again, it's a gamble if the stock doesn't go down. If it goes down, though, the contract will be worth much less money. You'll make money on that, but you'll lose money on your stock, and the broker might put in a cash call against you, where you might have to come up with $2,000, and you only made $800 on the contract. You need to come up with $1,200 more to hold your position. This is why those who use margin to buy stock will write a contract much closer into the price of the stock to get a much larger premium in cash. And they will use that $2,000 or $2,500, like I was telling you, some of these $220 contracts. They'll take in this $2,000, $2,300 and put it against that $8,000 margin that they borrowed. Now they only owe $6,000 in margin, and they've got an $18,500 stock with a $220 call against it. And they're waiting now to see if the shares back off a little bit or don't move at all. The call drops in value each day it goes by, as you've seen. The closer to the exercise day, the less value these calls have. And eventually, this person will buy the call back at maybe $5 a contract, having sold them for 23, turn right around and write a brand new call for a month later for another $2,000, $2,200, and bring in another $2,300 against that call, that margin position. So they went from $8,500 to $6,000 up to $6,500 down to $4,000 owing on the stock. And as each contract is rewritten and rolled over, they're knocking down the balance owing on that margin call to the point where they knock it out and they own 100 shares free and clear, don't owe anything against it. All depending on what the stock does and the options do and everything else. This is a very complicated game that can be played here if you want to get into it, but you've got to watch what's going on. And you have it. I was watching delayed for the last 10 minutes. I was missing live Bruce. Not for beginners. That's true. It is. I can explain it in plain English, but it's not necessarily for beginners. That's exactly right. Old McDonald had a data farm. Bruce, you're making me want to buy more GameStop. Well, what can I say? You have to accept certain risks and certain tolerances when you get into these markets, whether you're just a buyer of the stock and you're just going to gain on the upside, if that's the way it's going to be for you. You're tolerating losses if there are losses, because money you're using is money you can afford to do without. Very good. On the other hand, you could say to yourself, I want my money working for me as hard as it can, as aggressively as possible. How can I make this happen for me? And one way to do it is to be an option writer, to offer call contracts against paper you already own. And if you don't have enough money to own 100 GameStop, but you have enough money to own 100 BlackBerry or 100 AMC or whatever, well, then you use that vehicle as your generator of contracts. You might play that. It might play that angle. It's totally up to you how you do it. GameStop is 185. Apple is 125. So you can buy Apple for less money than GameStop and write contracts against Apple. You will not get the same premiums, though, from Apple that you will from GameStop. The GameStop premiums are higher per share than for Apple because GameStop has more volatility. Apple doesn't. But it's still the same business. It's a long-term way to draw money in from the market while putting money into the market. And if you can generate a 15 or a 20 or 30% return per year on option premiums on a conservative basis, that is an excellent return on your capital. And you can do that in some cases inside tax-free accounts, depending on where you live, Canada, US, what instruments you're using, 401ks, Roths, whatever. This is where you and your tax advisor have a chat and figure out what you can and cannot do. All right. Very good. I thought this was all a video game. Vanguard denied my application to do options. I'm not sure what their requirements are. I can't tell you. Some firms have virtually no requirements to do options. Others have specific requirements. I don't know. Might be how much money you're using, how much money you want. I do not know. Let's go. How long have you been into this GameStop story, Brucey? I don't have any contracts. I don't own any stock. I don't own any positions in GameStop. I'm not an investor. But I did my first video on GameStop last June, I think it was. I think it was back in June. I did a video when I launched this channel back in June of 2020, I had caught an article that drew my attention to GameStop when I noticed how many shares were shorted at that time against this $4.80 stock. The stock was at $4.80 a share, and there was this unbelievable short position on GameStop. I had never heard of Reddit, never heard of Wall Street Bets, never heard of the Reddit crowd or anything like that. The stock was not being talked about on any CNBC telecast. There was nobody following it. But I looked up this article about some of the most shorted companies out there, and I noticed that the top of the list was GameStop. So I looked into the corporate story of GameStop. I knew of the stores. I have seen them in the past. And so I did some digging on it, and I made a video about it back in June last year. And then I did follow-up videos after that from time to time. And then I came across the Ryan Cohen story, and I started covering that. And then I came across how the stock was being talked about because the shares are going up in value. I was mentioning it on my on the live shows. I was mentioning GameStop on my live shows on my other channel, Traveling with Bruce, where people would say to me, "You remember that video you did back in June on the stock market channel you got? I bought some of that stuff at $4.80 a share. You know, it's trading at $6 now, eh? Thanks a lot. That was a good tip." And then a week or two later, someone would say, "I also bought some of that stuff when you mentioned it. It's now at $9.50 a share. This is going great." And then people were buying into the GameStop, even as I was doing my live shows on my other channel, because I wasn't doing live shows about the stock market here like I am now. And people were mentioning to me, "You should start talking about that on your other channel, because I bet you a bunch of your viewers own this stuff." And sure enough, by January, I started to go live here because of what was happening with the stock. And I've been live ever since on this channel. And of course, we went from 1,200 subscribers in December to where we are now, 105,000 something, following this story, and continue to follow it. And I keep continuing to try to bring up ways for you folks to take advantage of this gift that you've been given from GameStop, especially those of you who have done, if you've done really well on it, I'm really happy. Those of you who are in at a higher price, there's a way for you to get your money back from this stock while you're waiting for the stock to give it to you. And that would be start writing contracts against this if you're in a position to do so. If you only have 15 shares, you can't write options. I get that. I understand. But for some of you out there who have several hundred of shares, 100 shares of this, 500 shares, 800 shares, 1,000 shares, 1,500 shares, you might want to consider writing options against this stock for maybe 1 or 2 weeks time frame only for a nice premium, and then be ready to buy those calls back on any kind of a pullback on this stock, where you've written them at $25 a share, these contracts, and the stock does an intraday dump when we see these attacks from time to time. You see the stock back off a little bit, or first thing in the morning, it's down $30 a share for no reason. This is where you buy these calls back and say, "Thank you very much. I'll take them back. And I'll grab them at $8. I wrote them at 28. Thanks. That's $20 a share in my hand. That help compensate me on this drop that we're seeing here. As the shares come back up again, I'll write them again. And if they only come up part of the way, that's all right. I'll write contracts at a lower exercise price, good for next Friday, and I'll take in another 20-something bucks a share. Thank you." There's always a gambler waiting to buy and sell contracts. They are an active market, and this is how you can take advantage of these swings of this stock when it wants to give it to you. It's I call it free money. I would take it. So there you go. Very good, everybody. Thank you, all of you. Yeah, I'm not sure about minis. I know that some stocks, there are mini contracts out there that represent 10 shares. I'm not sure if anything to do with a GameStop or not. I've spent days checking out the SPACs. I bought VGAC, SVAC, NSH, and GHVI. I'm still checking more on the others. I'm trying to not let the feeling don't want to miss out get me. That's the hardest part. I hear you there. And you know, some days it's just a great day to buy a SPAC when the price is so cheap. They're being offered to you on a silver platter all around the $10 pricing that they came out at. Man, is that a gift. To me, I see SPACs trading at $9.98 like NavSite Holdings. The satellite data providing company. I mean, this company is going to just make money and money and money and money with what's their risk? They don't own the satellite. They manage the satellite, the data up and down. They're just data managers. They're going to be paid all kinds of money to manage, to move data. I mean, it's just so simple. Other companies launch them. Other companies own them. And then there's the data handlers. That's what these guys are. $9.98 a share. This is a joke. This is a license to print money. And if the satellite falters, it's not their problem. They don't keep the satellite up there. They move data to another satellite and manage the data there. It is so basic to me. It is boring in a way. It is not sexy. Kind of sexy, but not sexy. Depends on what turns you on. If you're into data management, that's sexy. These guys are going to make a fortune, an absolute fortune, managing data forever. Forever. There's no stopping this business. And I can see them just getting larger and larger and larger as they handle more data for more companies and more satellites, because more satellites are being launched all the time. Private satellite launchers are coming out like crazy. This is a growth business. It doesn't sound exciting, but it is exciting. Every credit card transaction, every debit card transaction, every time you buy a coffee at Starbucks, you are responsible for data transfer every time, and they have to transfer the data from the location to the head office to the servers. It's up there. It's 1/1,000,000th of a penny per data point. I don't even know what it is. It doesn't matter. There are trillions of data points moving every second all over the place. These guys are going to make a killing. You can buy it at $9.98. I don't know how much easier an opportunity can land on your lap to buy this. You buy the contracts on this stuff. You want to buy call contracts for, say, June, July, and August. You can buy 10s or 1050s or 11s. I bet you they're pennies. I bet you they're cheap. Load up. You can control thousands of shares of this company for not a lot of money, and just sit back and go, okay, go ahead, do your merger. Go on. You're listed. Take the money, expand your business, announce your deals, and I'll just clean up. If this thing goes to $20 a share, I'm sitting on call contracts at 11 or 12. Thank you for making me rich. I appreciate it. It's just a nice little gift being handed to you. Like I say, Gore's Holdings at $13.95, VGAC at $10.06. Oh my God. 23andMe at $10.06 a share. A $950 million check is coming into the hands of 23andMe on the first day of trading. $950 million in cash. The entire time that 23andMe has existed, 8 years, they've raised $800 million. Now they're being handed a check for $950 million on the first day of being a public company in one shot. Here it is. I think they can bring in $2 billion more anytime they need it. That's all. They send a text. They could bring in $2 billion more anytime they want it. I don't know how this stock is at 10.07 the minute this deal is listed as 23andMe. I don't know. I'm obviously missing something because, or maybe the market is missing something. Maybe that's it. It's just not being talked about. It's not ready yet. They're not saying a word. Everyone's quiet. It's the quiet period. Folks, you've got an opportunity. You just have to decide when to take it. And that's what I talked about this morning. On the first 15 minutes of this show, I talked about how early this morning, you come to a fork in the road and you have to take it sometimes. You have to decide, which way am I going? Am I taking this path? Am I taking this path? Where am I going in my life? And here are 7 SPACs, all of which have announced deals. They're being funded with oodles of cash, and these shares are dirt cheap. And none of them are trading at ridiculous prices with hundreds of dollars of hundreds of times earnings multiples or worth $2 a share, trading at $100 a share. None of that stuff at all. You're not buying into over-leveraged, ridiculously leveraged companies. You are buying into solid, cash-flowing entities that have been around a while that are probably going to expand very quickly. and they could be in a few years themselves takeover targets, possibly, but they're likely going to gobble up all kinds of smaller companies that they're aware of, all their competition. They're going to gobble them all up, and they're just going to build up their value and their asset base and their cash flows and their reach. And they're going to add directors from some of these companies in as directors to help manage the new business. Oh gosh, it's exciting. It looks good. Anyway, folks, it's all we can do. We're going up. That's right, Michael. We're just going higher. What can I say? What can I say? Oh man, Ashley Parcells. I forgot I have IPOE in my other house. I forgot all about it. Welcome all to the show. Got VGAC at 10:05. Good, bad, very good, very good, very good. Yes, indeed, man. These SPACs are a bigger gamble when you buy them at 10 on the initial IPO. That's when they're a bigger gamble. Now buying them here, knowing what they're going to become, it's a less of a gamble. There's much less risk in it. This Gores Holdings, nobody knew that Gores Holdings would acquire or be acquired by Matterport. But now we know. We know Gores Holdings is going to become Matterport. And Matterport is firing on all cylinders. This is a private company on fire. They're going to be making a ton of money. And it's all going to be in their public corporation, which is right now what Gores is. 1 for 1, you're going to become a Matterport shareholder buying the Gores stock, $13.93 a share. It's already been to 28 on the hype. That doesn't get it. It was double this price already before when the deal was only 2 weeks old. It was only 2 weeks announced. It was double. You're getting it at less than half of what it's already done when they announced the deal. Hello? I think it'll be way more than 28 after the deal is concluded. I think so. I think it's got a whole lot of upside beyond that, but it's $13.93 right now. You got to gamble. $13.93 a share is not a gamble. Oh my gosh, what can I say? Guys? Bruce, how did the market keep track of options before computers? Oh my God. Yeah, we started in 82, I think, 81, 82 with the options. And I remember the quote machine that we had. We had a terminal that was on a swivel or kind of a thing. And this was connected to phone lines. It was connected to kind of like what cable television was connected to. We had a cable into the wall, and it was then connected to wherever the server of this thing was, somewhere in Calgary. And then that was connected to the stock exchange server systems, whatever those were. Oh my God. And we could get one quote at a time on this machine. And the last quote you typed in was the quote that was sitting on that screen all day long. So if you wanted to know what the Dow was doing, you had to hit the DJII button, enter, and it would show you the Dow Jones at that moment in time. You want to know what the NASDAQ was? It was an NASDQ. I can't remember the symbol, and enter one at a time. Oh my gosh. How did we keep on top of the markets? Oh man, did we have to be, we had paper. We had paper. Oh my God. Jay Civic, Bruce, I was informed SPACs are a ripoff and require the retail investor to be the fool so everyone else wins. Oh, okay. Then why are there 200 of them out there being launched by some of the smartest people in the world? Why are they creating SPAC after SPAC after SPAC? Gores Holdings is the fifth one. Gores, this is the fifth Gores Holdings. There's the sixth one coming up too. All four Gores Holdings that are out there are all successful. I don't know where this is coming from. I don't know, my friend. Yeah, why would Richard Branson bother to get involved with a SPAC if he is he interested in ripping off retail investors? Is that what would make Richard Branson a happy guy? I don't think so. Yeah, I don't think so. How did we handle the stock market before computers? Oh my gosh. I remember in 84, 85, we got in brand new terminals and we had a screen on, big terminal thing. It was a tube screen, right? The old desktop type computer. And I now could have 25 different stocks on the screen at the same time, and they updated. Oh my God. Oh, the technology advanced from 82 to 84. Oh, my word, the world was exploding. I could then watch different contracts and I could see the price of stock and the indexes. And then I had a little window at the bottom with news announcements coming up, headlines. And we still had our Dow Jones ticker machine over there, printing away all day long. That was the hard copy. You trusted that thing. Everything else we weren't so sure about, but you trusted that. That was the Newswire service. We had that going on. The Dow Jones news service coming across. We had reams of paper, rolls and rolls of this brown paper that we had to change out all the time because this machine kept rolling and rolling and rolling and just spitting out. And as the day went on, we would take 8-foot long sections of this tape, cut it, and add it to a clipboard hanging on the wall. So at the end of the day, we would have these 2 clipboards hanging on the wall. Each one would have 100 sections of 8 feet of paper with all the headlines that had been spit out all day long. And if you wanted to get some news to a customer of yours, and they had a fax machine, we had the modern technology. We would take that ticker and we would cut out the article on the stock that we were following. We would photocopy it. We would come back to the ticker, tape it back to the 8-foot section, put it back on the wall. We would then take the photocopy, would write a note to, Joe, this is the latest on IBM's earnings, whatever it is. We would fax it to our client, and the customer would get in their office this fax with a photocopy of the Dow Jones ticker that the broker sent them with a handwritten note with circling the parts of the note you should read here, and then we'd talk on the phone. That was cutting edge communication between stockbroker and client to stay on top of breaking stock news. 1984, 85, 86, right up until the 90s, that was the way it was. Internet? When did you have internet in your house? When did you have internet in your office? It would have been in the early 90s. 90, 91, 92 would be the beginning of internet. And even then, the ability to copy and paste an article on your computer and then send it to your client didn't exist for a long time. Oh my gosh, I remember those days. But I was out of the business for a while until I entered it back in the Cayman Islands back in 98, 99. And then I had my own Bloomberg machine, my own Bloomberg terminal, and a computer over here. And I could send and receive messages with my clients, emails and stuff. Oh, how the market had changed and had it matured. And oh my gosh, unbelievable. So Bruce, in 1970, Uncle Bruce, in 79, would we physically meet? And I would actually write a written promise to sell you shares at a strike price of a future date. No, it would be all done on the phone. I would talk to you about your stock. You'd have 100 shares of, say, GameStop. And we decide together, the broker and the client, want to write a $200 call contract, and I would give you an indication of what the market looked like. And so we'd agree, if you can get $20 a share for this contract, I'll write that contract. I'll say, leave it with me. I'll keep working on it. And I've got the quote of the stock on my screen. And I know that with the stock at 184.96, that if the shares could get up to 186 or so, that call contract that we want to sell will likely be trading at $20. That's the price we want to sell at. And so I would enter a sell order to write one call contract as an opening transaction. That is writing a covered call. And I would indicate that it's a covered call. The form, a little ticket I wrote had all these little boxes that I had to fill in. I had to fill in the account number. I had to fill in my broker account number or my code, put in the price I wanted to sell it at, and I would hand that ticket to my desk trader. The desk trader would look it over and go, okay, you're writing a covered call. I see what's going on here. And he would then phone up his trading desk supervisor, probably in Toronto, put in the order, and it would then reach the options market from that trader to that floor. And on Chicago, there would be a floor trader who would receive an order to write one covered call, GameStop, April 30 at $200 exercise at $20. And he would hand single his floor trader on the pit, and he would receive it. He would write that down in his little book. I got to sell a call of GameStop for April 30 at 200. a $200 exercise price at 20. And everyone would be watching the stock, and the options market would constantly change. And then he would yell out, sold one call, April 30, 200, blah, blah, bought. And someone would say, I bought it off you. So now that deal's done. He writes his ticket. The other guy writes his ticket. They initial each other's book. They then take it to their timestamp machine, chink, hand it to their floor runner, or the floor runner would come and get it from them, run back to the phone guy, and the phone guy would call back and say, you just sold a call at $20, exercise $200, GameStop. And that floor desk trader would call our desk trader. The desk trader would pull the ticket out of the slot, fill it in, write down in his order book that he just sold this. So the house has a record of the trade. The ticket is set into 3 separate pieces, one for the broker, one for the desk trader, one for the cage at the back. And now I get the copy. I go, okay, we sold it. Now I would call you up and say, we've written a call contract against GameStop for April the 30th, $200 strike price at $20, just like we wanted. And the first question out of your mouth is, what's it trading at now? How we doing? And we take a look at the stock and we'd say, oh, it's up another 20 cents, and the call is trading at 20.05. Okay, well, no big deal. We're in at 20. We're out at 20. We now want to buy it back for less. And it has 3.5 weeks to live. So the rest of the day, I'm watching that stock all the time. I call you up once or twice a day. We keep each other posted what's going on. I call your office. You're in a meeting. I tell your secretary, I don't need to talk to him. Just tell him this. Write this down for me. Jerry, GameStop, 181 a share, last trade. All right. Then below that, write down option trading at $18. Below that, put in a smiley face for me and just leave it on his desk. And he can call me whenever. And then half an hour later, the client would call up and say, hey, how you doing? I just got out of the meeting. I just got this message. I guess we're doing all right. I said, yeah, the shares are off a little bit, and the contract is losing ground. Let me give you the latest update, and then I give him a live quote on the spot. And that's how we did it. And we would have a strategy in place where he would say, well, what should we buy it back for? And I would say, well, you're out of the money right now at 185, 182. We're out of the money. But, as the days go by, this contract will shrink in value. And, once it gets under 10, we'll start looking at it maybe as a buy. We'll buy it back. We'll see how many days are left, how far out of the money are we, or what premium is left, and we'll maximize our returns. So a week goes by and the stock is still 185. The contract is now at 15. It's got 1.5 weeks left to live. A week later, it's trading at $10, $8. A week later, within the last 3 days, the stock's 190. The call is at $3, $4 because it's $10 out of the money. We would now talk about the strategy of maybe we should buy this one back. And why don't we write a new one? Why don't we write a brand new 3-week contract that expires in 2 or 3 Fridays from now at what? 200, 205? The stock's a little higher. Maybe we should write a 210. And we'll take a look at the quote, find our deal. Okay, we've decided to write a 210 at $20 a share again. We put in a buy order to buy back that call, the first call. I put that order in. I get it. I put in a market order to buy it, or I buy it at the value that's trading at. Within 10 minutes, I get the confirmation. We got that one. We're out. We're flat. Okay, now we're going to write the new one, and we write the new one at the price we want. Hand it to my trader. Goes into the system all over again. Here we go again, and we're trying to write the next one. And if we're successful, we write it, and we've got a new position in a new call. We made maybe $15 on the first call, net of commissions. Now we're writing the second contract, and here we go. And that's how a broker and a client try to make money together. The broker gets paid a commission on everything he sells and buys. The customer makes a profit beyond that on the positions. And if he has 100 shares, we're writing one contract. If he has 200 shares, we're writing 2 contracts. If there's 500 shares, we're writing 5 contracts. The more contracts I write, the more commission I make, because the more money we're talking about. And the broker and the client are trying to build a relationship and make money together. And if I've got 15 clients doing the same thing, or 20 clients doing the same thing, I'm a busy guy. I might have 20 clients doing exactly the same trading all the time, and I'm doing exactly the same options, the same exercise price, the same strategy, and all these clients who don't know each other are saying, yeah, Bruce, you're the man. Write these calls, buy back these calls. Let's stay on top of this market. You're the guy at the machine. I'm in my office. I'm working. make me money. And so that's how this game would work back then. Today, it's all do it yourself. Click, click, click on this little thing right here. Buy and sell everything you want. Write the calls. Take your premiums. Enjoy. Very, very different. Completely different. It's an amazing world in which we live. Anyway, there you have it. A little memory lane walk back and a little idea about how trading used to be done and how it's done today. It's essentially the same thing. There's really no difference to how we do it. It's similar, similar markets, similar premiums. It's all relatively the same thing. It's just how you what's your tolerance level, and the commissions have completely changed out. The middleman is gone. Your advisor is no longer here. You're on your own now. You got to do it by yourself, unless you have a big account and you can afford the services of a large brokerage firm where they charge you a percentage of your value, and that includes an option specialist. Boy, have you got to have money under admin to have an option specialist working for you full time. These guys cost a fortune. I'm free. You can talk to me all you want about these. But I can only give you limited info. You're on your own after this. It's all we can do. By the way, thank you for giving me thumbs ups today on this show. I appreciate it. We have 946 thumbs ups going right now, 947. Only 45 on the down dip. Thank you for this wonderful ratio up to down. If you can keep those thumbs ups coming in before we finish off the day, I would appreciate it. We're getting close to signing off for the afternoon. I hope you enjoyed today's two shows that we did today. I hope you found that you've learned something new today about this business and how this market works. 973 thumbs ups. We're going to hit 1,000, I think, before we're off the air. This is great. 986. Here they come. Here come the thumbs ups. Thank you. We will be on again tomorrow. I will be on 1 hour before the opening. We'll see how the market opens up. There's 1,000 thumbs ups. Thank you, everybody, so much for that. 20-to-1 ratio, thumbs ups to thumbs downs. Thank you very much. Let's keep that going, and I appreciate it. We're going to stay on top of things. Scott Combin, Scott, thank you again for your donation to my channel. Where am I here? I'm just looking for Scott. Hang on here. There it is, Scott Coleman, London, England, every day, making a donation to my channel through PayPal. I do hope I get to meet you and Jen in person one day. Thanks again for everything. Thank you so much for your support of this YouTuber from over there in the UK. I do appreciate it, Scott. I don't every day mention you, and I apologize for that. Sometimes I just lose you in all the activity that's going on here. I've got so much to watch for at the same time, but thank you again, all of you out there who have been doing super chats to me and super stickers, becoming members of this channel. I can't thank you enough. I so appreciate this. Jen and I are just thrilled that you enjoy hanging out with Uncle Bruce. We love you guys, and I just love talking about the markets, as you've probably gathered. Love following it. Some days are very hectic here, where we just are covering minute-to-minute trades. Other days it's a little quieter, so we can talk about a number of different things and different angles. I do appreciate that. Bruce, is it a bad idea to buy GameStop using margin account? Margin account's good or bad? Like I said earlier, on a momentum trade, there's nothing wrong with it. You take a run with the stock, get in and then get out, and you build a position that way, if that's the way you're doing it. Sometimes you're using margin to get you up to 100 shares, so you can write options. You might have 82 shares. You buy 18 on margin. You now have 100. Now you're writing a call contract against the position, which is equal to how much you borrowed to get the 18 shares, as an example. That's a good way to go. 2-3 weeks later, the option dies either worthless, or you buy it back for a very small amount of money, and you are not even using margin anymore, or you're using margin to get, you say you own 200 shares and you buy stock on margin to buy 100 more to get to 300 shares, and now you're writing 3 call contracts at $20 a piece. That's $6,000 coming in the front door, going against the $18,000 you borrowed to buy that 100 shares. Now you're down to a $12,000 IOU to your broker. You have 3,300 shares under admin. You got 3 contracts on the go. That's another way to use leverage in a conservative way to build a portfolio. Some of you have 800 shares. You're going to buy 200 on margin to write 10 calls. good on you. Do that as well. It's all up to your risk tolerance level and how much you want to pull it, how much of that margin you want to borrow against versus what your equity position is. Okay, Uncle Bruce, I'm still going to nibble a tiny bit on the other SPACs too, but mostly because I like this channel. Thank you, everybody. Thank you all for being here today, watching me here, hanging out. Hope you're making money now. I hope you're going to make a lot more soon. Those of you who are looking for one-on-one consultations, I look forward to those. We've got another full slate this weekend, and we're setting up the weekend after that, and the weekend after that. I will try to book you in as soon as I can. Sometimes I get some of you who come into me and say, I'd like to see you ASAP. I'm paying you right now for a session, and I get last-minute cancellations from time to time. I can slot you in. If you're available, I'm available. We work with you to try to get together with you. Thank you, all of you, for visiting with me one-on-one and also here during the day. Fantastic, everybody. I got to say goodbye and call it a day. I hope you've enjoyed today's sessions. I've enjoyed being with you today. Have a great evening, everybody. We'll catch you tomorrow morning, 1 hour before the opening, and let's get together. This should be a lot of fun. Stay well and healthy. Exactly. Go take a nap, and thank you. Thank you. All right, guys, there it is. Final report on GameStop. We're now at 185.11, up 60 cents in the aftermarket. Not much happening. 66,000 traded. Very calm here. The Dow ended up losing 96.95 points, only 0.3 of a percentage point. No big deal. S&P lost 4 points. Who cares? NASDAQ lost 7 points. Who cares? No big deal. We came out of today very unscathed. Let's see what happens tomorrow. Let's see if GameStop says anything about these new directors. Oh, I can't wait to hear about some of these folks. I am hopeful that we're going to hear some really neat stuff. We got some neat emojis coming up here. Neat. Thank you, everybody. Everybody have a good night. We'll see you tomorrow morning at 8:30 Eastern time, 5:30 my time. We'll do it all again, and let's see if we can make a bunch of money. Thank you, guys. Looking good, Billy Ray. Thank you, guys. Have a good one. We'll talk to you later. Bye for